Goldman Sachs chief U.S. equity strategist David Kostin does join us to talk about what we've been through past couple of weeks and what today may mean. David, great to see you. Thanks for being with us.
Thanks, Carl. Nice to see you.
I've read your notes, but I'd love you to verbalize your thoughts on that rate scare and the degree to which you think flows are, I guess, a net reassuring dynamic.
Well, Carl, I think the way to think about the equity market is through the lens of the bond market. And we want to think about duration, kind of the average time in the future you're going to be getting the cash flows for a company. And the bottom line is when rates are rising, you want to shorten the duration in a bond portfolio. The same thing holds for equities. That it benefits the cyclical companies as compared with these longer duration technology stocks in general. And so that's, I think, explains to us the significant rotation, if you will, out of technology and particularly the longer term secular growth companies into a more cyclical type of market. I think that's been the story in the last month.
Does that mean that the rotation out of high multiple tech names is mostly done?
Well, the question is on a either day-to-day basis, or we certainly know today is a huge recovery and rally, if you will, in NASDAQ in particular. But the issue really is what's happening on the margin. We have huge fiscal stimulus coming, likely to be signed in the next day or so. We like to have very significant improvement in the vaccination process, more than 2 million people a day. So those things are about nearer term activity, and that really does benefit an improvement of the business fundamentals for some of the near term, more cyclical related stocks in the recovery trade, if you will. So if you want to think about it longer term, sure, technology, secular growth, those are definitely tapping into some of the evolutions in what's happening in the economy. But near term, tactically, it's likely to be cyclical, Carl.
David, I mean, we got more direct checks going out to at least some Americans, expected at some point in the next couple of weeks. We certainly know there's been this rise in the retail investor and that some of that previous stimulus money has made its way to the market. What are your expectations now?
So, Morgan, you tap on a key issue, which is where's the demand coming from investors, broadly speaking, to push the market higher? A lot of those stimulus checks, of course, will be spent, but from a household perspective, that's the key source of demand as we see it to push equities higher in 2021. And so to put some numbers around that, there's about $5 trillion that are in money market mutual funds right now. It's been coming down since the start of the year. And the issue is how much more will that shift, those assets shift from money market funds into other asset classes? And typically, when bond yields are rising, that is the experience. You have, the fundamental data would suggest that you get flows coming from cash into equities. And that's a big story. We think there's more than $350 billion likely to come out from households and shift into equities. I think that's a big story. Not so much the stimulus particularly, but rather the higher rates, both real rates and inflation expectations. That history would suggest that's increased demand for equity shares, and I think that's going to be a key story for this year.
We've seen this rally in international stocks. We've had a number of guests on who talk about emerging markets as an emerging investing opportunity. Right now, how do you see it? Is U.S. still the best, or are there other opportunities out there that need to be considered, especially when you're talking about value as the new momentum play?
Right. So from a value perspective, certainly the international equities, say European equities, is a starting point for a moment. That is always been a lower multiple universe, the index, because they have far less tech. 7% of the European index is tech compared with something in the vicinity of around 20 to 25% here in the United States. So there's a much less tech, much more cyclical type of business activity. But really the fundamental economics here in the U.S., much better rollout so far in the vaccinations, big fiscal stimulus. I think that benefits some of the rally here in the U.S. So I think from a risk-adjusted basis, risk-adjusted returns, Morgan, still suggests the U.S. is the better, if you will, return prospects. But the flows have been remarkable in terms of the power of money going into non-U.S. stocks. So that more than $100 billion in the first 2 months of the year go from or into non-U.S. oriented or global or international related mutual funds. About $60 billion has come into domestically. So a lot of flows in the U.S. moving internationally, less less expensive stocks, looking at the weaker dollar, sort of interesting opportunities overseas. But I think risk-adjusted, it's still here in the United States.
David, I know you spent a little time writing about SPACs lately. It's funny. A show doesn't usually go an hour or more long without us talking about it. But, to the extent we look at them and their buying power and what their influence is going to be in the market and or the companies that are being taken public, just give me some feel. And I'm curious as what kind of questions you get from investors about it as well.
So, David, a huge amount of interest and focus on questions about SPACs. So put a couple of numbers around that. There have been already this year, a huge number, more than almost $60 billion of new equity capital has been raised in the SPAC world. That is on pace for this year, will be exceeding last year's total by the end of March. There's about 5 deals a day are going public. So the amount of new issuance is very significant. You're looking around 320 portfolios, if you will, of SPACs, David, that are out looking for acquisitions. There's probably 180 or so deals in registrations. You're looking, let's put some round numbers on that, 500 deals, capital raised in SPACs looking for acquisitions. And I think that is a key story that is sort of been developing, the amount of capital that's been coming into the market in those areas. Have you seen lots? The real story, coming back to the Carl's question about duration, or not the duration, the way I answered the question is the longest duration investment is some of these SPACs, because a bunch of cash has been raised in a trust and they're looking to make an investment, in many cases, longer term, really, I won't say concept stocks that don't have a lot of cash flow necessarily near term, but have big growth prospects out in the future. That's fundamentally a duration trade. So that's an interesting dynamic, David. Money's coming in and it's shifting towards much longer term stocks.
Yeah, but David, you've written repeatedly that at least the pace of SPACs and the way in which they're soaking up IPO volume is not sustainable. Have you clarified when you think that non-sustainable trend comes off?
Well, the idea of investors looking for an opportunity set, it's about rates, as far as I'm concerned. The idea of the Fed pushing rates to zero, effectively, has meant the opportunity cost of investing in a SPAC versus owning cash is quite minimal. You get your stable value. It's in a trust, so you have the cash value, say $10 a share. You have your opportunity set to have the warrant, and you have your put option if you don't like the deal that's been announced. So as long as rates, Carl, stay pinned pretty close to zero, the trend towards SPACs is likely to continue. The opportunity set is very significant. For many, many years, you've had a diminution in the number of publicly traded companies in the United States. Now we're starting slowly to reverse that. As I said, about 500, probably in that vicinity of new transactions are likely to be effectively in the public market. So we're kind of moving back towards ability to access capital in this environment is pretty attractive. Rates are low, and there's a lot of private businesses that are looking to tap in to more permanent related capital, especially thinking about where the anniversary of what happened last year. The idea of solvency and liquidity is still something that's on the mind of a lot of private companies.
Oh, that's such a key point, David. We were just talking about a year ago today what the market action was like, and maybe there is this new sense that it's good to have a large rainy day fund. We got to run, but David, a great set of notes the last couple of weeks. Appreciate it. David Kostin, Goldman Sachs.
Shepard Smith here. Thanks for watching CNBC on YouTube.